All right, welcome everyone. This is Siwin Yi from the Yi Real Estate Network, and my speaker for today is Mr. Richard Smith. He's a licensed tax advisor from the San Francisco Bay Area, although he serves investors all over the country, or it does not matter really where you live. So he is something unique. He's been doing tax advising for many, many years. And he has many, many clients. And his focus is on real estate investors. He understands what's going on. And he himself is a very serious risk investors as well. He has invested out of state investment properties all over the country. He has so many properties. I'm not going to mention how many because it'll make you feel sick to your stomach. But we're not here to talk about his real estate portfolio. We're here to talk about some very, really important and urgent message about, taxes, right? Taxes is such an important topic, but we only have a mere 30 minutes for this presentation. We can talk about two important topics on the Biden's tax proposal plan. We can, maybe in a future podcast, hopefully in the next month or so, we might, Richard Smith is very, very busy. I really appreciate his time to spend with us. So hopefully we can bring him back so we can talk about other important tax topics that are important to real estate investors. So Richard Smith, thank you for attending. Without further ado, I'm going to share this screen that was provided to me by Richard. And if I could find it, where did it go? No,
That's why I called early.
Yeah, because I had it. Hold on, let me minimize my screen. Hold on. Oh, I need to find it. Hold on. I had it on. Let me.
See, we can start over if you want to.
No, it's okay. So, all right, I think I have it. Do you see it, Richard?
Oh, I do. It's perfect. Thank you very much.
Perfect. Yeah, although there are about 13 topics on here, but we can talk about two very important timely tax topics, and they are, one of them is 1031 tax deferred exchange, as the other one is, as you can see, which is the sixth bullet point down, eliminate step up in basis on death for capital gain taxes and real estate. So let's go over the last bullet point, proposed elimination of the 1031 tax deferred exchange for real estate. So without further ado, Richard Smith, please go ahead and do your important presentation on this topic.
Thank you, C-Wing. I just came back from vacation yesterday, so this is fun for me to do. But the letter you have in front of you is not our corrected one. This one, let me modify the one you have. So under Biden proposed tax plans, the very first item has been deleted. President Biden had mentioned that last week. They're no longer imposing a 12.4% Social Security tax on incomes above 400,000. They dropped that. So that was really good for people in Silicon Valley to know. So that's been eliminated. So please cross that off. And the next big change was really a big change, was the very last item that C-Wing mentioned, eliminating the 1031 tax deferred exchange for real estate. We're going to modify that, which Mr. Biden came out recently and said, what I want you to add to it is says, it will only eliminate the 1031 tax deferred exchange for real estate for sales over 1 million. So that means a lot of us, like C-Wing and I, are buying properties, in Texas and Florida and all these beautiful places we like now. We can still sell our property. And of course, remember, this is all proposed. There's nothing on here that's cast in concrete. And every day you're going to hear something, as I do, as my clients call me and they say, well, I heard about this or I heard about that. And I said, remember, it's only proposed. And Senator Manchin from West Virginia keeps talking about the fact. Now, remember, this is really, really critical. On these lists that we have, it only takes one Democratic senator to say no. And we think that's what could happen, because there's a lot of these proposed tax changes that would really affect our congressmen who have real estate. For example, the one that Sealing had pointed out, eliminate step-up basis, which is the fourth item. Step-up base on death for capital gains taxes and real estate. This is probably the toughest one for us to deal with, because current law says if you die, your heirs inherit your property, but their cost basis on the property is the fair market value of the date of death. So you get all your properties appraised, whether it's your principal residence or whether it's a rental property. You get them appraised, and there's no tax due on death. There's no death taxes in this country. And so when you inherit that property, your cost basis becomes the fair market value the day he or she died. So you could sell the property the next day and pay no tax. Well, Mr. Biden is proposing that we do away with that. It's been federal law. I've been doing it 40 years, and it's been as long as I know and longer, that he wants you to pay taxes on your properties when you pass away. So all the gain you've had, your little house in San Jose, I had a client recently who sold his house in Cupertino for $2.6 million. He bought it for $16,000 in 1967. So that means in his case, if he was unmarried, he would pay tax on the difference between $16,000 and $2.6 million. So what concerns us, in fact, I just visited a client of mine on my vacation who recently diagnosed with cancer. I was sharing with Seawing. He's got 45 rentals plus a beautiful home on the lake. And, that's the most terrible tax law I've ever heard of. And remember, you need to notify your senators or your congressmen. Remember, the Senate split 50-50, 50 Democrats, 50 Republicans. So, I think, the House is completely different. I think there's 15 advantage of the Democrats, but it only takes Senator Manchin to vote against his Democratic senators, and that would not pass. But that's a serious proposed change, and it's really hard for me to imagine that after having this for hundreds of years, that all of a sudden the government has decided you should pay tax on your property. Now, I just talked to a client this morning. He's in his 80s and he's concerned about what you're reading on the screen and what you saw. And we could, if you want a copy of that, we can send that to Seawing and he can send it to you. You can call my office and my office number is 408-446-5551. And we can email it or mail it to you. But the corrected copy is what I'm referring to. But this client, he and his wife, currently, their estate exemption is 11.7 million for each of them. So if their combined is, what is that, $23 million, they would not pay tax on. His concern was, what would happen to him? And he'd already talked to his estate planning attorney. But what happened was I said, well, how big is your estate? He said, about $4 million. And I said, well, you're going to be covered because Biden's proposed reduction from 11.7 to 3.5 million each. So 3.5 million for him, 3.5 million for his wife. So they have an estate exclusion of 7 million. They would not pay tax. Remember, when you're talking about married couples, the first one dies, no taxes due. All the properties, in his case, his house and his rentals would pass to his wife. And, she would inherit those. So most attorneys would set up a living trust. Most of us have one. I hope you do. And so that would be the automatic procedure that when the husband dies, the property be inherited by the wife. And if Biden does change it to 3.5 million each or whatever, but that's the number most people talk about. That's what it was when Mr. Obama left office. It was 3.5 million. And then they raised it up to where it is now. And it goes up every year. So that's a serious change in the law. And if that does happen, I would say people under, 6 or 7 million, which covers most people that we talk to, not everyone, but it covers most of them, they would pay no tax on death. Now, the question about paying it when you die, so in that case, this client I talked to, his wife had inherited. So when she passed away, she would face taxes depending on the estate values of that part. But what most of these states are set up to do is that, when the first person passes away, the husband, which is normally true, we transfer his assets into a bypass trust. That's the most common way to do it. So those assets don't go to the wife. If they set up an irrevocable trust on the death of the first partner, then those assets would not be included in a wife's when she were to pass away. So I look at that, and for most people we talk to, and I'm sure a lot of people listening, 6 or 7 million should cover most people, but it won't cover everybody. But the clients I'm talking to that have those kind of assets, that would be everything: your house, your real estate, your stocks, your bonds, all of your investments. I would say most people are probably pretty safe from that. 6 or 7 million should take care of most people in the valley that we talk to. So, the thing that's happening right now, of course, the next question for everybody is, when is this going to take place? We don't feel there's going to be a tax law change this year, although they are having hearings. Both the Senate and the House are having hearings. All tax bills originate in the House Ways and Means Committee, and there's no bill yet. So people always ask, well, if they change the law, when does it become active, and is it retroactive? And sometimes they have made them retroactive, but in the 40 years I've been doing it, I've never seen them go past the date the bill was introduced in the House Ways and Means. Well, that hasn't happened yet. Here, what are we talking, June? We haven't seen that yet. So that's going to be the date that you have to be careful. Now, a lot of times they're pushed into the future, and I've heard people talk that, it wouldn't occur. We don't feel it's, at this point, speculating, we don't feel it's going to occur in 2021 because it's going to take a while for the House to debate it, come up with a bill, a tax bill, has to go to the Senate. They never accept the House bill. They always have their own variety. They always want to make their own changes. So the Senate would come up with its own tax bill, and they wouldn't agree. So they had to go back to a conference committee for the Senate and House to agree on a combined bill. I mean, this can take 6 months. The Trump bill that passed, December of what year was that? That was 17. That took quite a while for them to put the bill together. So, you're going to be well advised. Everybody's going to be, advising you on when it might take place. They're usually not retroactive. The worst I've seen, of course, is the date the bill was presented in the House. That's usually the bill, but they don't use that. I mean, even in the Trump bill, which was signed December 20 something of 2017, most of that bill didn't take place until 2018. So, there's a lot of room. Don't get worried about it yet. And if you see something happening, that you've got questions, contact C-Wing or contact me. The other portion that's causing a lot of stress in this list we have is and you've read about this because I can't pick up anything without seeing it. They're talking about taxing long-term capital gains and qualified dividends at a rate of 39.6 on incomes above $1 million. Now, when it says on incomes above $1 million, we think that's number 3. We think that's probably adjusted gross. It could also be taxable income, but that's a big change. Right now the current law is 15% for the low values and 20%, for people above 200,000 or 300,000. I can't remember, been on vacation too long. But they're talking about raising it, so they would tax you at 39.6 on the amount above 400,000. But remember, when you're talking about 400,000, you've got your ordinary wages and dividends, and maybe that's 100 or 200, and then the capital gains is added on top of that to get you to the 400. So it doesn't take much to get over 400 when you add income and capital gains together. That, remember, on top of that, you're going to pay another California tax of 9.3 to 12.3, depending on your gross income. So it's single people, above 250 or 300, it goes out to 11%. So that's one that worries me probably more than the other one, because that's going to affect everybody. That's going to affect your ordinary dividends and capital gains you get from your mutual funds and your stock dividends, but then added on top of that, it's going to be any sales for capital gains. So this is talking about long-term capital gains. Now, there's a bunch of other changes. Some of these really concern me, like phase out of qualified business income for self-employed, like I am. Today, small businesses and people who are self-employed get a deduction on their tax return equal to 20% of the net profit. Well, that's significant. If you have a realtor or somebody making, 300,000 or 400,000, and they get a new 20% deduction, which was the big issue, one of the big pluses in the Trump tax bill, and now they're talking about doing away with it already. So, I hate to see that go, but there will be changes, and of course, they'll come up with new ones. One that doesn't affect most of you, Biden wants to raise the corporate income tax rate for IRS. It's currently 21%, and they want to raise it to 28%. So, those will affect our corporation. But the corporate tax planning we do is we are trying to zero out most of our corporations so they pay no tax. And then 70% of the corporations are S corps, which pay no tax. This would only affect C corps that would be taxed if they have a profit. So remember, on those C corps, which we do a lot of those too, you can make distributions in payroll, and I'm working with a couple of my C corps right now to increase their retirement plans for their individuals. So that's a great thing to do. If you've got corporations, you need to sit down and talk to somebody about doing some planning for it. They've got new things. They talked about a new residential energy credit. They talked about a new electrical vehicle tax credit. They talked about a new home tax credit. I mean, and this is the menu list that happens what do we got? What do we got? 350 House of Representatives and 100 senators. Well, they've all got good ideas. They all want to go back and tell their constituents what a good job they're doing, and by saying, I got this bill passed, or I got this provision passed. So there's a lot of new ideas that will come up. I don't think this is going to happen overnight. And most people are betting it won't happen this year, but they have had hearings already this year in both the House and the Senate. And Mr. Biden put out his budget recently, and I was going to share that with Seawing. It just came out in his new budget of things he'd like to include. Let's see what else we got. Let's see. Biden's plan. Oh, child and dependent care. Now, this is something that's happening right now. It's already happening. So they've increased the deduction for families who have small children. And currently, you're able to deduct a $2,000 for each child in your family, which is a pretty decent deduction up until age 17. Above that, it drops to 500. They're talking about changing that, and it's already going to happen. July 1, it's going to happen. Not for this year. Yeah, it's going to happen this year. So what they're doing, if your child is less than 6, I believe, that new exemption is going to increase from 2,000 to 3,600, and from 6 to 17, it's going to increase from 2,000 to 3,000 per child, which is significant. Those are really good deductions. And so what the government has decided to do, and this is hard for me to believe, starting July 1, they're going to start sending out checks to people. I expect we're going to get a bunch of calls from people when they get these checks for $80 for each child. They're going to know what the government is providing. So they're also talking about another stimulus bill. We've had 3, but they're talking about a 4th one. So we can't talk about that because that's not on here and we haven't seen it yet. But on the child dependency credit, they're going to figure out what that's going to mean to you. So your 2021 return, if you had a dependent at the end of the year when you prepare your 2021 return, you'd get a $2,000 deduction. Well, they're going to change the law, so they're going to get 3.6 or 3,000. So they're going to calculate that small difference and then start mailing out checks July 1. So if any of you get a check for $80 or $60 or whatever, they figure out you're going to save, they're giving it to you in advance. Well, we're not saying this to our clients yet because no one's called us, but you can always say, I don't want that. I'll wait and save it and do it when I file my tax return. But that's a brand new thing. I thought that was, after doing this for a long, long time, I've never seen the government step up to do that, to start sending out checks for $80 or $60 or whatever. It's a prorated, above 150, it starts phasing out. So a lot of our clients won't see any amount of credit, but there will be a credit form, for those who qualify. And we don't have it in writing. What is this? Oh, this is a big one. I didn't notice this the first time. I haven't looked at this. I've been on vacation for 10 days. It expands to child and dependent care. That's where you hire somebody to take care of your minor child, or you do it through your flex plan at work. You're going to expand the child and dependent care credit from a maximum of $3,000 to $8,000 per child. or 16,000 max for 2 children or more. To me, that is phenomenal. And I think we're going to see a lot of people that will benefit from that. Today it doesn't help a lot, but they do get a small credit. So what we tell our clients, you're much better off. You get a higher deduction for childcare payments if you're in a flex plan, a 125 plan at work. You can get more as a deduction on that flex plan than you can by doing it outside the flex plan and doing it yourself. But that's a great change. I mean, childcare, I'm talking to what some of these parents are paying for childcare. It's horrendous. It truly is what they're paying. And, it's something that you'd be aware of. Again, we've got a list of 13 or 14, whatever we've got here, and they won't all be passed. And the ones that C-Wing, pointed out that the 1031, I don't know if that'll pass. I mean, I know a lot of senators must have real estate also, so I'm not sure that'll pass. The last time they changed it, we used to be able to exchange 1031 other things other than real estate, like cars, and there were other things. There were a few other things you could do. But now, when the law changed last in 2018, they eliminated all of the 1031 exchange tax deferral systems except for real estate. Now, I'm not sure why Biden decides he'd like to eliminate that. But again, remember what I said in the beginning: if the sale's less than $1 million, I did 7 1031 exchanges myself last year as I'm moving properties around and trying to find. C-Wing and I are always looking for new places to buy real estate in places that make sense, because obviously it's pretty hard, to buy in California. Not impossible. We do have some clients able to buy in California. I have a client who just bought a rental house in Clear Lake for $213,000. I went up to see it. I actually had to go see it. I couldn't believe you could buy a house. It'll rent for probably, what would it rent for? Probably $1,700, $1,1700 for something like that. So C-Wing, that's what he's in charge of, is finding you great places to buy new property. I'm amazed that you can still buy a property in California and get the good effects of Prop 13. And he bought a house. It was a 2-bedroom, 1-bath. It was about 10 years old, really in good shape, in a nice part of town. He was 2 blocks from a police station. I thought that was good. I mean, I don't know anything about Clear Lake. It's not where I'm going to buy. But C-Wing, do you have any questions? I've been rambling here for a long time. Do you have any questions I could answer?
Yeah, no question. You were providing some very, very good high-level recaps on a lot of significant tax changes. So it's a good snapshot from a high level. But as always, each individual person, they have to go over their unique tax situation. That's why, Richard, you do what you do, right? I mean,
I love it. Yeah, I love what I do.
Yeah.
Well, I'll tell you, one thing that's important, I didn't mention it, because of these proposed changes, and whether, most people aren't keeping up with their taxes like they should, like you and I do. You might sit down and do some planning at year end. We offer year-end tax planning for our clients. We have about 50 people come see us every year and sit down, particularly for self-employed people, for self-employed persons. We most of them want to know, what they can do. The other thing I think people are missing is retirement plans. For example, I've got to throw this one out. I've done it about 5 times for clients. So I have clients whose husbands have retired and their spouses are still working. So very successful realtors, making very, very good income. Their husband's retired. So what we've been doing for about the last 10 years, we hire those retired husbands to work for their wives as gophers, and we pay them anywhere from $20,000 to $40,000. Now they actually have to work. But they can pay them on a 1099, and the wives are on 1099. So let me just give you an example. So we have a client last year. She paid her husband $40,000 to help her run around and manage all of her real estate listings and the title company work and all that. So she paid him $40,000. She deducted $40,000 as an expense on her Schedule C. Her husband claimed it as income, but he opened a solo 401k retirement plan. Some of them call individual 401k plans. Some of them call them self-employed 401ks. He did Fidelity or Schwab, which we recommend. Because of these small payment amounts, he was able to put 36,000 of the 40 into his own retirement plan and subtract that as a business expense. That's phenomenal. Plus, he's got his own money he can now manage in his retirement. Plus, he gets to write off his car and his cell phone and lunches for clients and all the other things. So he essentially is able to wipe out the $40,000 that his wife paid him and deducted 100%. Now, she also did a solo 401k herself that she was also able to deduct and eliminated. I mean, they put over, I think it was over $90,000 into retirement for last year. And they've been doing it for 4 or 5 years. And so a lot of people aren't aware of this. And I'm puzzled, you know, Celia and I are in it every day. But what a great way to put away a lot of money. That's the best way I've ever seen. Although I do have one better. This one will just knock you off the building, I think. When my wife and I got together about 7 years ago, she joined my business. And the first year I paid her like $25,000. The second year I paid her about $40,000. And she said, I'd like to make more money. I'm working too damn hard to manage your office. So I talked to my pension person and he said, well, what do you want to pay her? I said, well, I don't know, probably $100,000 to manage my office. This will knock you over. So I paid her $100,000 the last 3 years, and she's 60 years old. So I opened a defined benefit retirement plan for her, and we have contributed $300,000 each year for the last 3 years.
Wow.
Now, most people don't believe that, but I did it when I had my own defined benefit. But she puts away $300,000 a year. That's the problem, is raising the money. But she now has $900,000 that we subtracted on our tax return. So the greatest shelter I've ever seen besides real estate are these defined benefit retirement plans. If you don't have one, you got to be over 50 basically to make it work. I had one, I read it for 10 years. I put away $2 million, which I now use to fund my hard money loans. So you've got to think about retirement sometimes. Sealing and I were talking about before he came on with you. You got to start thinking about retirement or what you're going to do and what you're going to have available to you. Now, a lot of people I'm talking to today are leaving the state. I mean, I can't tell you how many people are leaving California.
Right.
And, you know, you've seen the numbers, you know, California for the first time ever lost population last year of 186,000. And that's including our birth rate, which is pretty significant. But people are leaving. The top 3 states, Washington State is number 1, Oregon is number 2, Texas is number 3. 2 of those 3 states are tax-free. And I'm in Texas, you know, 2 or 3 times a year, you know, reviewing my real estate. But people are moving to Texas and Florida like you've never seen, and Washington. Washington, of course, being number 1 for California people who are leaving to go to. But there's a lot to be done. I'm helping a client right now move to Nevada. And, you know, we got to get his business out of Nevada, which we'll do. You know, we can do that for him. But he's looking at paying $170,000 this year to California if he doesn't get out of here. So I don't know what kind of topics can I add to that, Seawing. What else might you have asking?
Well, Richard, you just touch on, you just give another motivation for us to do several more Zoom webinars. So you just spill the beans, because all these topics are so timely, so important. It's all about year-round tax planning. Okay,
yes.
I know, you know, time's almost up. Believe it or not, you know, it's just time.
We took a half hour. Oh my God.
Time flies when you have good tax fun. Who said taxes are boring? I mean,
I've never thought that. Hey, let me give him one more thing. You don't have my phone number and you don't have my email. So let me give, there's at the bottom. My email is Richard, RICHARD, at richardsmithtax.com. Richard at richardsmithtax.com.
Yeah.
You can try my phone. It's not as successful because it's summertime. We're closed on Fridays. My phone number is 408-446-5551. So you've got questions. The topic right now, I'm sorry, I spread my advice too far out, but I'm always looking to help people. And all of these are good ideas. Seawing's got great properties you should look at. I believe in everything he's doing. I own in 7 states. I've got over 100 rentals and 2 apartments. And there's a lot of nice places to buy real estate. And thanks to Seawing, we work with some of his clients, helping him on these properties. I'm telling you, there's more places than California. That was surprising. I could give that one tip for California, but please call me or email me and we'll try and help you. And Seawing, thank you for inviting me. I definitely enjoyed it. My first day back from vacation. This is not work. This is fun.
Absolutely, Richard. Yeah, you really provide some great contents. It's just a great inspirational, motivational information. So a lot of good tips for everyone. And it's thank you so much for presenting this, Richard. And I would love to bring you back. I will I will be persistent and I will nag you for the next webinar. I'm sure a lot of investors are looking forward to hearing from you some more, and we can look forward for some live events,
Yeah,
maybe later this year, maybe early next year, and invite
yes,
Smith back to our club meeting at the Santa Clara
yes.
Hotel there.
I miss our club meetings. I really miss it. I miss the seminar. Webinars are good, but I prefer the live touch. I really like to reach out, and answer questions. And that's the only thing I missed today. I didn't have a chance to answer any of your questions. So I told Seawing, let's see how you react and how many good questions you can come up with, and we'll look forward to it. I've got summer vacation scheduled for the next, what do we got, next 2 months. I'm going to Maui next week for 2 weeks, but get some vacation, do some tax planning. Let's help you lower your taxes and help you make some good investments.
Wow. Well, sounds great. With that said, thank you so much, Mr. Richard Smith from San Jose, and he helped investors from everywhere in the country, not just from California. So
All right.
thank you so much for attending this. We will record this Zoom webinar, and all our database will get a copy of this video and also get a copy of your tax letter that we've been presenting. So once again, thank you so much. This is Si Wing Yi from the Yi Real Estate Network. Thank you so much. Have a nice day. Bye-bye.
Thank you, Sealing.